Good afternoon, everyone. How's everyone doing? Good. My name is Paul Zarling. We're going to get these things started. I didn't realize it was 12 o'clock already. I was talking to a few tables. My name is Paul Zarling. I'm the managing partner here for Client First. It's my pleasure to introduce the speakers for our education event today. But before I do, just a couple of housekeeping items. And then, I like to throw some trivia in there, too. So we're going to do that. And I like to make it topical. I know Justin, when he does, he likes to make it weather-related, which is totally fine. He can do that. I like to make it topical, so we're going to talk about the stock market today. How many stock markets are there in the world? Okay, a lot does not count as an answer, so we have to have some sort of number. So, how many? 5, okay. 12? 30? All right, there's over 60. There's over 60. Right, America accounts for about 40% of all volume, so that's kind of fun. The top 5, just so you have, I'm not going to ask you this, but I've had you, so you have the info, is the New York Stock Exchange, the NASDAQ, and then those are the first 2, and then we shift over to Asia for the other 3 for the top 5, so Shanghai, Japan, and Hong Kong. Now here's the fun one though. Which one's the smallest? Smallest stock market in the world? Darn, no? Any other guesses? The Seychelles Exchange. You anybody know where the Seychelles are? Great place to vacation, by the way. Yeah, she's.
I've never not gone, but I've heard about it.
Yeah, so it's a great place, but the Seychelles maybe has 100 million in it compared to everything else. So there's some stock market trivia for you. I'm going to introduce the speakers. I'm excited that they're here. So we've got David Zarling, who has been navigating markets for closing on 20 years or more. And then we have Dan Garguber, who's our talented individual from Western Minnesota as well. I appreciate these guys because how long have you heard like, hey, the 60-40 portfolio hasn't kind of been working? From us, you've heard it for almost 2 years. Now people are finally coming around to it. So I really appreciate these guys putting that all together and having the knowledge and also, looking at what was all going on to kind of make that statement kind of come out strong with it. So really appreciate them, what they do for me and my portfolio, and what they do for all of your portfolio as well. So I'm going to turn over to Dave and Dan, and he's got his cap on, so that means he's really ready, folks. So get your pens out, take a lot of notes. Round of applause for David and then Dan when you see him. All right, thank you.
Thank you, Paul. I appreciate that introduction. Paul always gets the fun part, right? Trivia, introducing the speaker. I've got to cover this legalese every time, right? Because our clients, we know them. We know their situation. We know what models they're in. If you're not a client with us, we don't know that information. So when we present today, it's for educational purposes. And so we have to keep that in mind. And yes, I have a hat on. I like to have a prop that has meaning when we do a presentation. If you remember last time in July, who was here in July? Okay, just checking if you're awake, and that's awesome that you were here in July. Do you remember what I was wearing in July? But there was a key piece of clothing I was wearing. Yes, I was wearing underwear.
Yeah, sure.
Brewers jersey. And I said if I was wearing it today, that would be important information. Not wearing it today. Very sad. I'm unemotional about it. So, but the purpose of my hat that I'll get to here shortly, we're building a leadership team at Client First, and we went to see a speaker. His name was Chad Williams, former Navy SEAL, I believe SEAL Team 1. He was in the closing battle in Fallujah. He's a follower of Jesus. But he spoke to us about things that make a great leader. And so he talked about I'm not going to go through all the principles of becoming a SEAL and all those things, but I took some notes. I thought it was really good. And he just talked about servant leadership is the glue to an organization. We are forged by adversity. So I want you to remember that because we're going to talk about some things, some emotional challenges we have when we go through market corrections. And that we need to have the ability to control emotions and actions no matter the circumstance. So those last 2 points are really what I want to focus on today when we think about market corrections and investor behavior. But there was something really interesting he also said that I wanted to highlight, and believe me, I have a point here. When you're going through to become a Navy SEAL, it's grueling. He said they sleep 4 hours during the week. They're running over 200 miles. His class of 173 ended at 13. He was one of them. When other people ask him, how in the world did you do that? Well, he said, it's not about the how, it's about the why. And so one of his tricks, and I don't want to call it a trick, I thought it was very good. They all wear their hats, and inside their hat, they write their motivation. So, I have some motivation here, and it actually introduces the next slide. So I've got Jesus, of course. I've got my clients. That's why I get up every day. I got my family. And then there's all these people and two new ones. Colt and Quinn. This is Quinn, what a great name. That's his brother Connor. Love the hair. Adorable. That is Ian's new child, Quinn. Ian McMillan, that's why he's not here. And this is fresh off the press. This is Kevin Ferrari's son, Colt. So if you know Kevin, Kevin is going to be an awesome dad, and that motivates me. So, now that we've established why we do what we do, or why that I'm here in front of you, let's get into it. When we do things at Client First, we're doing it similar to a family office. Okay, so a family office is a term used in our industry for teams of experts that surround billionaire families. So if you think about these billionaire families, they have their own CPA, they have their own CFP, they have their own CMT, they have their own attorneys. That's what we're building. All these different pieces fit into your financial puzzle. Today we're going to happen to be talking about adaptively responding to markets, but it goes hand in hand with everything that it fits into the true holistic plan that our clients are familiar with. And that's why on this slide, right, we have people like Justin and Brad, Brad's currently in Philadelphia studying for his Certified Financial Planner designation. It's a huge designation, but we're bringing that expertise in. We have chartered market technicians, we have insurance specialists, we have tax specialists, we have CPAs. These are the experts we're bringing to bear on behalf of our clients. What are we going to cover today? We're going to talk about the multi-year correction that we've been through, recency bias, and loss aversion. Those are fun terms. This is going to be a little bit of a psychology class. Are we in the start of a new bear market? Did it ever end? How bonds and dollars impact portfolios. Dan's going to come up and talk a bit about that. Seasonality and politics, everybody's favorite topic. We're about to lose all our airwaves and TV stations for the next couple months because all the TV ads are going to come out. Our least favorite season. We'll have a time for Q&A, a preface to the Q&A. Because Kevin is out of the office, Dan and I will be splitting from here back to the office to do our regular day jobs, which is managing risk and taking on any trades that we need to take on. So we won't be hanging around afterwards. But we are going to do a Q&A. It's at that time that we encourage you to raise your hand, ask questions. We'd be happy to answer them. And then Paul will break it down with final thoughts and some housekeeping. So, painting the environment that we've been in for a while. So many of you're on TV, they talk about the Dow Jones a lot. They might talk about the NASDAQ, and they might talk about the S&P 500. Okay, so Dow Jones, 30 stocks, NASDAQ 100, 100 stocks, S&P 500, technically 505 stocks. They have a lot of overlap between the three of them, and they're perfectly appropriate for them to talk about. But often we don't talk about the next round, the next group of stocks, what's happening underneath the surface. And so I thought this chart did a good job explaining or showing what's been going on for 5 years. We are at the same spot that we were back in October, right? When we think about markets, we often marry ourselves to S&P 500, and all the low was in October. Well, we're back there for the majority of stocks. Okay, not many people are talking about that. We've had 3 20-plus corrections in 5 years, 3 and 5. We usually have 1 every 4.5. So volatility is up. This range, and being fully transparent, this range right here is the largest range we've seen in 50 years. It's also when our system has underperformed. So many models during this period of time, for us, this is called a trendless environment. Models have underperformed. We're in an environment where we've both gone through a 20-plus correction and underperformance over what would be a decent amount of time, right? 34 months, 2 years and 10 months. And for context, I should clarify, 2021, adaptive models, positive for the year. 2022, not positive by the year. 2 of the 3 models outperformed to the downside, meaning they just went down less. In this current market environment, from here, this is where most underperformance happened. We've been in that range in the Russell 2000 for 18 months. So 2 years and 10 months of nothing but down or sideways for a lot of stocks. This chart here is the value line geometric index. You don't need to remember the name of it. What it does is it takes basically the New York Stock Exchange, not exactly, the New York Stock Exchange composite is about 2,000 stocks. This is 1,700. It equally weights them, and then every day says, hey, what's the average return of these stocks? And it makes a nice index. So the average return, and I'd like to anchor your point to what we talked about in the past, January of 2018 is when Volmageddon took place. That's when a lot of places really got beat up pretty bad because they were short volatility, and then the volatility instruments blew up. There were firms that went under, there were individuals that experienced extreme pain, and the irony being that since that point, all we've seen is volatility, and you can see it in this chart. Not only have we gone 2.5 years, 2 years, 10 months sideways, you could argue that the average return of these 1,700 stocks are basically down from that time frame. This is equal weight Russell 1000. So think about the S&P 500, which is a cap-weighted product. So think of cap-weighted, not in this type of cap, though they're fun. The size. So Apple is about 12% of the S&P 500. So there's 500 stocks, but Apple is 12% of that. This takes that weighting out and says everything is equally weighted in the S&P 500, and then the next 1,000 stocks. So think about your major leagues and your minor leagues. It's in the same situation. It's back towards its October lows. So we've seen actually large caps lead. That's why when you look at these two different charts, this is the S&P 500. So there's some nuance here. Notice how we're above this range, and we'll get into this in a little bit, but we're also above the January high, but it's holding up a little higher. The S&P is. Well, this chart I've embedded on the left here, this is the Magnificent Seven. Those are, well, I don't want to ask this question. I'm going to ask it, but don't be insulted by it. In the 50s and 60s, there was something called the Nifty 50. Does anybody remember this? Probably not, because you probably weren't necessarily investing. But it was these 50 conglomerates, international companies, that were notorious for outperforming the market. And so now we have ourselves the Magnificent Seven. That's Apple, it's Google, Microsoft, Amazon, NVIDIA, Facebook, and Tesla. Those 7 companies now make up over 30% of the S&P 500. So think about a pizza pie that's called the S&P 500, and 30% of it is 7 stocks. That's why you see such a difference between this chart and this chart. It's really, now don't get me wrong, there's other stocks that are up during this period. I just want to drive home the picture that while above the surface, we've been focused on these Magnificent Seven, and appropriately, that's fine. Underneath the surface, we are back to our October lows. So while many in the financial media will be like, oh, we're on the bull market's restarted, that's still to be determined because of the market being held up by those strong stocks. What we would like to see, going back to even the Russell 2000, is this level here This is when stocks sold off in 2018. 2018 seems like an age ago. You know, I've got a kid in college now. I don't think that kid was in high school. COVID crash. We're at that level. Buyers have showed up consistently there. We need buyers to show up here again. Otherwise, we've got problems. And we'll talk about our game plan for that problem coming up. The other interesting thing about this environment that Dan's going to talk about, that we've been talking about for quite a while, is the industry likes to package 60-40 portfolios to most of the investing public. 60% stocks, 40% bonds. It might be a variation. It might be 70-30. It might be 50-50. But even that slice of the portfolio is down more than stocks in this, well, or I should say equivalently to stocks over these last 34 months. So no trend in stocks, downtrend in stocks, downtrend in bonds, downtrend in commodities. So all the major asset classes in a downtrend, one of the things that affects investors is like, throw your hands up in the air. When are we going to see a market where we can grow accounts? Let's walk through that. God gave us these amazing human brains, and I know the topic du jour is artificial intelligence, okay? And I understand the fear behind that, but I can tell you that the greatest artificial intelligence besides Jesus Christ that was ever created, God himself and the man he created, we have the greatest intelligence that exists. AI is going to be great. It's going to make us the most productive people on the planet. That's for a separate presentation. But what I want to talk about is some of the things that we are in the habit of doing as humans that are both good, but they can be a pitfall. One of them is loss aversion. Fancy name. Basically, walk yourself through the example of walking out the door. You've got a $100 bill in your wallet. You get in the car. You go to the store. You run your errands. You get back home. You didn't use that $100, but it's not in your wallet. Terrible, right? That pain exceeds the excitement of finding a $100 bill on the ground. It's human nature. We feel pain of loss greater than we do the joy of gain. Make sense? Or hopefully I didn't lose you on that. So when we think about markets, this is a problem. The Dow Jones from 1900 through today, if we were just looking at it by days, not looking at a chart, this is why we use charts in our process. If you just looked at it by days, one day pain, one day joy, one day pain, one day joy. But you would think that the market is negative since 1900 through today if you just looked at it that way. So we have to be aware of our cognitive biases. When we combine that with recency bias, that also becomes problematic. And recency bias, I gave an example here of, you live in Salt Lake City or Park City, Utah, and you normally get X amount of snow per January. So you buy that four-wheel drive vehicle to make sure you can get around the mountains. And the next January, it only snows like a foot. And you're like, what? Why did I do this? It's because you're living outside the averages, or what's happened, you're living on the most recent information first rather than taking the collective. And what do I mean by that? For context, if I don't break this down for you, duration-wise, there was a time where we had uptrends. It was a beautiful time. And we could grow accounts, and it was awesome. There was a downtrend, and that was actually beautiful because during this period of time, if you look back on the chart, commodities were actually an uptrend, and we could own some commodities, and we could actually grow accounts. Now we have nothing to grow accounts with. We've underperformed in this 20% chop area. And immediately our mind goes to, this must be my future. Forever. That's not true. And that's part of the reason why I'm here, is to remind you that that's not true. That's from April 18, by the way, back in April. This was our game plan. If you remember, if we stayed below this area, we're going to have neutral position in stocks. Below it, we were going to be out. Above it, we were going to participate. So July, this is July's slide. We did get above. Clients noticed that, we're back into growing accounts, right? June and July, our accounts are rising back up in value. This is a great thing. And now we're in a 2-month correction. in a seasonal period where it's normal to have a 2-month correction, but we should be involved with it because the uptrend is now engaged. Okay, we are still in an uptrend until we break back below. We'll get into the game plan later. But so you went through pain, there was small gain, and now we've been in a 2-month correction, and you're thinking, oh, are we doing this again? I'm not here to tell you whether we're doing that or not again. We have a game plan if we're heading back into that, but I know that this is where mistakes happen for investors. This is where they throw their hands up and say, get me out, at just the wrong time. So we've been in a 2-month correction, perfectly normal. This is what it would look like if we were just looking at it on a monthly return basis. So if we didn't use charts, this absolutely would look like this, right? If we're just using a bar graph and looking at monthly data, and we're not using a chart to see that there's a difference between what's going on here and what's going on here, we would think it's the same, when it's not. It's not the same. It could become the same, but that's my hook. I'm going to keep that curiosity in you while Dan comes up here shortly. But our deal is we want to have a plan rather than a bias. And the plan is actually really simple. And believe it or not, there's this thing out there called say it 7 times to make it stick. So I'm here to tell you, this is now my 7th time, talking about 4180 on the S&P 500. Anybody else remember me talking about that? Paul does. I've got 4 market write-up letters to you that bring up 4180 and countless podcast episodes talking about 4180. And here's the snippet from the write-up. This one's from May. It matches the ones from March and April. It also matches what we talked about in the podcast. But it's really simple. We need to get it back above the 200-day moving average and stay there. The blue line that's running through here now is the 200-day moving average. So we got above it. We've pulled back to it. We need to stay above it. Second step, we need to regain the 4080, 4180 level. Period. And we need to stay there. We got above 4180 in June. We were able to grow client accounts June and July. We've now pulled back in August and September, which is normal. That part is normal. And now we need to see sustained trading above that level. And the game plan is really simple. Stay above here, we can be invested. If we cross back below here, we're not going to have anything to do with stocks. And we'll be holding cash and T-bills and client accounts. And when people ask me, what's your differentiator? What makes you guys different? I would say it's the people and the processes. I showed you all the people. We have a lot of processes. I can tell you that we don't do true holistic planning like anybody else. Finances are messy, and we use human brains to get it accomplished. We don't just use an algorithm. Same thing with markets. We don't have a bias. We don't have a narrative. I may have a personal political favorite, but I don't have a favorite for the market. We have to have a plan, and our plan is quite simple. And that's our differentiator: is do you have a plan for the next leg down, if there is one? I'm not saying there is, but if there is a next leg down, what's the plan? So with that, I'm going to have Dan Gorkuber come up. He's another chartered market technician. I always pinch myself when I say that. There's about 4,000 of us in the world, and we have 4 of them. So we think we've cornered the market a little bit on that, and we're happy about it. But he's going to come up and talk about dollars and bonds. Welcome, Dan.
Thank you, Dave. But yes, I'm going to run through some dollar charts, why that is important for our process and what we do day in and day out, and then also look at some bond charts as well, and then maybe get into some 60-40 as Paul kind of alluded to in the beginning. Before I get to the next slide here, just want a quick show of hands. Would you rather, and there's no right or wrong answer to this, so don't be afraid. For us here, would you rather have a rising dollar, United States dollar, our home currency, right? Would you rather see that dollar value go higher, or would you rather see that dollar value go lower? Just a show of hands if you want to see it go higher. Our home currency, you want to see that thing as high as possible. Show of hands. Okay, we've got a few. How about, would you rather see it really low as possible? Show of hands. Okay, we have a couple. It's good. I'd argue it depends, right? There's pros and cons to both. In relation to the market, I'm going to get into some of this and how it can affect some of our decisions. If you're traveling, right? If you're traveling overseas, it's a great time to travel right now in terms of our dollar value, because we have a high dollar value in relation to other currencies. So you're gonna see more bang for your buck, right? But in terms of what I'll get into in a little bit is from a market perspective, we're going to see some correlations that we just want to be aware of. This is a monthly dollar chart showing right here. You'll see a really key level for us where we're dealing in long-term levels, really this 102, 102.5 level from a long-term monthly perspective. Kind of keep that or mark that down as a note. We're going to refer to it in letters, podcasts, our own analysis. Okay, and here's just a quick little weekly level, same level of that dollar index. Again, you're going to see that 102, 102.50 level. A lot of different inflection points around that level. What I mean by inflection points is that you're going to see throughout the history of this chart, right? It goes back pre-1970, or excuse me, pre-1980. You're going to see a lot of touches of this 102, 102.50 level that to us signify more of a supply and demand zone, right? A key inflection zone that we want to be aware of. Currently, we're above that, okay? So keep that in mind. We're above that level, right? For traveling, that's great. When you go overseas, that's great. You're going to get the bang for your buck. However, for every gimme, there is a gotcha. You've heard that, right? And if you were here in the summer, I believe Kevin built this chart. Kevin built this chart, this slide, and we're going to reuse it because it's so important for this environment right now to kind of get this point across. And that's really what I want to say is it's all about the environment. What environment is the dollar index in right now? And it's in a rising environment, okay? And so the correlation that we tend to see with a rising dollar is really negative on domestic stocks, negative on foreign stocks, okay, negative on bonds, and negative on commodities. What did Dave just walk you through for 20 minutes of charts? And what I'm going to continue to walk you through is a lot of this negative domestic stocks, negative foreign stocks, negative bonds, negative commodities, okay? Now, from an expectation standpoint, right, if the dollar does end up going below that 102, 102.50 level that we marked previously, okay, we should expect to see some of that positive, okay, results out of domestic stocks, foreign stocks, bonds, etc. Okay, that's the environment we're currently in. Can that environment change? Absolutely. Can we be here a year from now and say, hey, this correlation is now not correct or not on the same correlation we are currently on? Absolutely. But the environment we're in right now, it's a negatively correlated environment in terms of rising dollar, negative to everything else. Okay. This is just a quick little chart showing in the top left the Vanguard FTSE All World. I believe that's VEU, ticker VEU. Okay. Top right, Russell 2000, which you just saw charts of from Dave. Okay. Bottom left, ILF ticker, Latin America. Okay, so I'm just trying to get some foreign exposure, some domestic exposure, right? And then some emerging markets exposure down below. And what this chart will kind of try to highlight as an example is if you have a green vertical line or vertical line on the chart there, that's going to be where the dollar, the Dixie, the tradewave dollar puts in more of a swing low. Okay, so you're going to start to see the dollar rise at that point. Okay. Conversely, a red vertical line is going to represent where the Dixie, the dollar, puts in a swing high. Okay, and you're going to notice, right? You're going to see this correlation, okay, take place on these charts from a swing high, swing low perspective. I didn't mark all of them. I just did it for an example in terms of what we're seeing and why we're in this environment, and why we believe we're continuing to stay in this environment with that correlation perspective. All right, so now we can talk about the elephant in the room, okay? And maybe better yet, rather than elephant, maybe the bear in the room, because it's the bond market, okay? The bear bond market that we're seeing right now, and again, these slides have been taken, might sound like a broken record, but for the last how many lunch and learns, a lot of these slides are going to be very similar. You're going to hear the same echo, right? Because the trend hasn't really changed from a bond perspective. You can see 21, 22, 23 on this chart, okay? Total returns for the 10-year Treasury bond, all negative. If this continues, it'll be the first 3-year in a row total market return where we've had that consecutive 3 years of negative results for 10-year bond market, okay? Now, who here, before I get to the next slide, who here were groomed, right? Bonds equal more safe haven, right? So we learned through school bonds are supposed to be safe. Is that correct? Or am I from Mars? I learned that, we learned that, right? Bonds are supposed to be safe. They're supposed to be less volatile than the market. Give me that constant coupon payment, that yield, and set me off in the sunset, right? Sounds good. Sounds really good. However, what if I told you long-term bonds, based on this chart, that goes back to 2005, so we don't have a ton of data on this chart, but enough data, right? Enough data points to where 3-month implied volatility of bonds. So just think bond volatility, okay? Bond movement is now more volatile or seen more volatile than stocks in the stock market. Would you guess that? I wouldn't have until we've seen the last year or so, right? There's an atmosphere changing, there's an environment that has changed, and we need to be adaptive and really available to change for that, right? For that environment that we've known for, and I'll get into a slide here shortly, for over 40 years, really, a 40-year cycle. So these next few charts, and just kind of bringing home and stressing home the point of the downtrend that we're seeing across the bond market, right? It's not just treasuries and the government. It's not just corporates. It's not just high yield. It's all of it, okay? U.S. aggregate bond, downtrend, almost breaching or almost to the 2008 lows for AGG. TLT, 20-year treasury bond, okay? Long-term, supposed to be your long-term safe haven. Just give me that coupon, right? We're trading levels that we saw 2003, 2005, 7, 8, downtrend. Guess what? Downtrend for the 3 to 7 year treasury bond. It goes on. International treasury. This is the lifetime charts of these things. We just saw fresh lows in 2022. We're coming upon them now again here today. High yield, okay, downtrend. Again, there's a theme. We're trading near the 2008 levels on a lot of these, 2020 levels on a lot of these. The atmosphere and the environment just changed to that. Local currency, again, what kind of trend? Say it with me. Downtrend. Now, one interesting thing is we will use relative ratios, right? Even within downtrends that we're seeing, okay, in a bond market, we can use relative ratios to kind of pick spots where, hey, there might be some strength here. We might have a potential trade here. One thing we wanted to point out is we are seeing less of a downtrend, right? The magnitude of the downtrend occur less in high yield. Okay, so this is JNK versus IEF. High yield is going down less than that of your 7 to 10 year treasury. Okay, so that's something to kind of keep in mind. We thought it was interesting. That horizontal level is a pretty big risk level for us, right? That we want to be kind of keep aware for potential trades. 20-year Treasury versus international Treasury, okay? Coming into a pretty big inflection point here that we've seen. Again, inflection point being points of interest that we've traded to in the past that we've seen moves away from or to, okay? 2018, some inflection points in 2012 through 15, again in pre-2010. This relative ratio, important to us, and we're watching, okay? Not sure what that was. Here's that 40-year cycle on interest rates that we're talking about a little bit ago. Bottom right chart that I want to bring you to. From 1941 to 1981, you've probably heard this in our lunch and learns, right? You got a 40-year cycle of rising interest rates there, okay? Fast forward to 1980s to 2020, right? Declining interest rate environment, 40-year cycles, okay? Now, since 2020, okay, we've seen this aggressive rise in interest rates, okay? Is this a new 40-year cycle that we're coming upon, or just really, 3 years into a 40-year cycle? I'd say TBD, but there's a lot of evidence that points towards we now have an uptrend in rates because we saw a bunch of downtrends in bonds, right? As we just saw. So now I'm going to kind of try to quickly go through the 60-40 for you guys, okay? 60-40, yay or nay, right? Just got done talking about bonds and interest rates and the downtrend we've seen there. 60-40 during rising rate environments is pretty all over the board in terms of absolute performance, as you see it on the bottom of this slide. Okay. Is it really that helpful to have 40% in bonds when it's more volatile, okay, than stocks even? As we saw a couple slides ago, I'd argue it probably isn't worthy to be in your portfolio. Here's a good proxy. So AOR is more of a growth style proxy in terms of allocation, okay? S&P 500 versus AOR is currently actually in an uptrend, okay? So just a general S&P 500, which is all stocks, right? All stocks, is in an uptrend versus AOR, which is more of a 60-40 portfolio ETF, okay? Outperforming S&P 500 versus AOR. Okay. And really the biggest thing, right, we talk about like a 60-40 is coming back to the point of volatility and downside, right? What's the downside and what's the volatility? Well, in the next few charts here, you're going to see performance-wise, right, there's a pretty big gap in performance when you look at year-to-date and 5-year. Orange line in the charts being the S&P 500 benchmark and a stock bond 60-40 portfolio, okay? That's a pretty wide margin of give there in performance. Is that given performance worth what we have coming up here of drawdown, okay, of volatility? They actually have fairly similar drawdown and volatility, okay, but you're getting less performance or less return in a 60-40 versus, like, again, the S&P 500 based on these charts. So with the 60-40, I guess kind of the point I want to drive home is that it's not all what it was made out to be, right? When they first started selling this stuff and really more market aficionados, if you will, really started to sell that safe, right? Be safe, 60-40, you have some stock, you have some growth, you have some bonds, right? Maybe someday it will be again, okay? I don't know. God knows. I don't. But we will be ready for if that were to happen and it can occur. But as of right now, we would want to be adaptive and available for trend changes in that. I'll bring Dave back on to kind of finish up with some seasonality.
Thanks, Dan.
Good job.
It's good to have guys like that on your team. There's some talent that Dan brings to the team that no one gets to see from time to time, and that one of them is being more patient with the Vikings than I am. And the other one is he does some volume profile analysis that is actually pretty cutting edge. So we're very thankful to have that on our team. I did want to touch base on seasonality. Seasonality, right? Like today, if you could just do the rest of your autumn like this would be tremendous seasonality. We would love that. But we all know the days that are coming, and that's why Dan wants you to eat dessert. But when we look at seasonality, there's some things, some clues that we can look for in the market environment. Not that they're predictors, it's just being aware. Similar to like if it was January in Wisconsin and you show up outside and it's 80 degrees. A little bit of a problem, probably. Some type of weapon has been launched or the sun is too close to the earth. I don't know what's going on, but 80 degrees in January would be a problem. Similarly, we can look at data from the past. So when we look at the Santa Claus rally, which is the last 5 days of the trading year and the first two, and then when we look at the first 5 days of January, and then when we look at January as a whole, when those three things were positive, as they were coming into this year, they do have a pretty high marking of potential upside in the market. So while most stocks are flat and some are even negative on the year, the S&P is positive, and this metric is based on the S&P 500. The S&P is positive. Yes, it's the Magnificent Seven, I get it, but nonetheless, we know based on this data that we tend to see a higher market. As of right now, it's up. Will that end that way? We don't know. If it's below 4180, we won't partake in it. I said 4180 the 8th time. Pre-election year, everybody's favorite. Typically, in general, if you want to think about pre-election year and election year, well, let's back up a little bit, actually. In general, forget it's any type of meaning of a year. It's just any year. Your strongest 6 months are November, December, January, February, March, and April. Like if you were to just be like, I don't know if I want to be invested the whole time, and you just pick the best 6 months, those would be the best 6 months. So we're heading into that period. In a pre-election year, that's not an exception. In a pre-election year, it's the same thing. So these are the last 124 years in a pre-presidential election year. Remember we talked about how exciting it was that we could grow client accounts in June and July, which is what happened. And now we've had a pullback in August and September heading into October. That's normal from a pre-election year seasonal. I'm not saying it feels good. I'm just saying it's normal from a seasonal perspective. I've marked on here a green line on where we are currently. I failed to update the red line, so forgive me for that. But what you do see from a seasonal perspective is you tend to, October is typically called a bear killer. Okay, that's typically when people get the most bearish and they get caught on the wrong side of the trade. They get out at the wrong side, wrong way. Now, I would relabel it the amplifier, the directional amplifier. If we're going to head upwards, we will head upwards from this point. But if we head downwards, it typically is an amplification of direction. And the proof I can use for that is 2018, 2002, and 2007. Those periods we saw amplification to the downside. And I don't bring that up to scare you. Remember, we have a game plan for that. I'm just saying that October tends to be an amplification month. So we have to have a game plan. So we're going to talk about that again. You're familiar with this. We're above a 200-day moving average. We have to stay there. We're above 4180. We have to stay there. We have to sustain that trade. And that's where we are currently. Now, it felt good to be able to have an uptrend and grow accounts again. We've pulled back. Doesn't feel good. Recency bias, loss aversion are in play. Now, a lot of times people might have a question like, when will the uptrend restart? Well, first stay above 4180. And then we can have an uptrend. If we don't, it's a longer case scenario for being able to grow accounts again. And what do I mean by that? If we're sitting in cash and T-bills, we're flat while the market's rolling over, and this typically will take some time to bottom. I don't want that to be the scenario because that probably means we have some other world issues going on, whether it's economically debt-based and, Lord willing, not war-based. Okay? So it's possible we have a game plan for it. Below the blue line, below 4180, we're in cash and T-bills. It's really that simple. I don't want to overcomplicate things. If there's one chart to remember, it's this one. If you go home and you really like these presentations, you're going to read them on your nightstand just because that you love to go to sleep to them. This is the chart. All right, so now I'm going to have Paul come up if you would, and we're going to open it up for some questions. So please be ready. As a reminder, this is the chance to ask us questions, because right when we're done with this, we're going to zoom out and head back to the office and get our jobs done.
All right, so I know that we are sitting at 12:49. I have a few questions that I've got, but I want to make sure you guys, while you have them, because I can ask these questions in the back of the office, right? So if you guys have questions like right now, raise your hand and we'll get going with your questions. If I don't see any, then I'll go into my questions. So here we go. We got a question right there.
Can you explain? I don't understand money market and how, without understand it, it's around maybe at a 5% rate right now. How can this money market make money in an environment like this?
Sure. So this question for those that may be watching the video, hey, money markets or maybe CDs, certificates of deposit, those are on the fives. How is anybody making, how are the institutions providing, how are they making money? So I'll turn it over to Dave to answer that one.
Yeah, and that's a multi-pronged probably response. When you think about coupons or interest rates that are paid, what they're paying for is for the money, right? So you give your money to an institution, they give you 5% back so they can keep the money that you gave them on their books, which they are then allowed to fractionally lend against. But your question is a good one from the standpoint of if a lot of their balance sheet is owning treasuries that are only yielding 2-3%, that does put them in a bind. So that's why you have seen maybe we've forgotten the thing that happened in March where you saw regional banks move quickly downward. It pulled a lot of financials with them. You saw Silicon Valley Bank go under, Signature Bank go under. I don't know if that scenario is gone because of what you just mentioned. So I believe the question was, how can they afford to do that? Some of them can't. And so I think there's going to be a weaning out process here based on what they're holding on their books. And there's another nuanced thing to this that is important, is there were some laws that have been passed about accounting for banks where they have to what's called mark to market those instruments. Now, a purist accountant loves that. At the same time, I would equate it to this. You guys all know where the Outer Banks is? Out in North Carolina. Beach houses, really nice. What is the Outer Banks house worth? Okay. What is it worth with a hurricane incoming? That's two different things. And so while the hurricane actually hasn't happened, you're supposed to mark the value of that instrument down. And that's what some of these banks are being forced to do, which actually causes them to try to generate more deposits and maybe incur more losses. It's very similar to, I want to be careful, but I do want to express some of the knowledge on this. 2008, part of the amplification of 2008 was something called FASB 157. You don't need to remember that. Maybe that's for the nightstand when you're trying to go to sleep. It's an accounting rule that was marked to market for mortgage bonds. So same scenario, but mortgage bonds. So some of the banks are being asked now to market their treasuries and some of their government bonds and things like that. So that could be a problem. And if we were to see the market roll over and we abide by our game plan, we get out and we're owning cash, a scenario, a catalyst that you would see, what would be the news? It's probably banks having trouble with their balance sheets because they have to market these instruments. That was a long answer. I'm sorry about that, but hopefully I gave enough.
Thank you, Dave. Other questions? Go ahead.
Are there any concerns in the commercial real estate market that could have an impact on the markets in general?
Sure. So the question was commercial real estate. There's a lot been written about it. What could that have an effect for the overall markets, given what's all happening with rates?
You're so kind, Dan.
What? You were around it, right?
Oh, yeah.
Okay, he's making an age joke. Thanks. So that there is a potential there. There's a unique scenario, right? We're coming off of COVID. What's wild to me about coming off of COVID is, I mean, my wife was testing COVID patients in April of that year. We had the fortune of knowing that it wasn't the 1 in 10 killer early. So I was back in the office by July of that year. You watch commercials now on TV, and they're almost pointed towards people who are going back to work, like into the office. And I'm like, wait, for 3 years you haven't been in the office? That's nuts. Yeah. And I love virtual. Like this Dan is from Alexandria, Minnesota, and he works virtual. That's great, and then we can do a hybrid. But I think there's always going to be demand for commercial space. But again, it's all about demand for money. And it's cyclical. If business isn't going well, and people are closing shop, and they're not able to occupy the place, then you have commercial loans that are going under. If the commercial loan was locked in at 2%, there's no real incentive until you're roll. Well, that's not true because a lot of commercial loans do roll. Like they have a 5-year roll where they're rolling into a new interest rate. So they might have some problems there. So yes, could there be problems in commercial real estate? Absolutely. Typically when the narrative gets strong enough, that's when you need to think the other way though.
Mm-hmm. Good question. Other questions? All right. So I'll go with one of mine. You guys crank out a ton of content with the podcast, market releases, all the fun stuff. You got your game plan. What other things or when it comes to election, right, Dan? Which party has like the upper hand when it comes to market behavior? Like if you vote this way, you're gonna get this kind of return.
Well, we're CMTs, right? I would say, based on the charts, I think we have, I don't know if we have them on hand, but I believe it's like a 50-50. It really doesn't matter. So kind of going back to what Dave brought in kind of right at the beginning of the luncheon of the hour here is we'll leave those biases and those desires and those passions on the side and really just manage risk, manage portfolios based on what the market participants, what the auction is telling us in terms of where the risk is. And maybe that favors a Democratic president, maybe that favors a Republican, maybe it favors an independent. I don't know. It's not for me to posture on, but we can make decisions within the market for your portfolios based on price, and that's what we'll stick with. Is that fair?
Yeah.
I was only going to add one thing that I find fascinating. So the reason why I ever became a technician is because we used to have all these fancy narratives about things, and then they would never turn out to be true. Example of this would be, what do you think are the worst performing areas, right? So we talked about underneath the Magnificent Seven. We're back to the October lows. There's other things that are 70% off their highs. What do you think some of the worst performers are? So you have a President Biden, a pretty liberal agenda. Since the beginning of 2021, marijuana, clean energy has sold off. The best performers, uranium and coal. It doesn't fit the narrative. Okay, now this is where I need to challenge you. The media gets you so focused on today that today's price movement is about today. It's not. Today's price movement is about 6 to 18 months in the future. So is uranium and coal predicting a strong Republican candidate? Possibly. Right? Because it's looking 6 to 12 months out in the future at what the prospects of our country are, or what the prospects of the regulations are really. And you're seeing things do better than the other way. So are we already seeing from a sector and industry perspective that the challenger of a Biden presidency has a good chance of winning? I could say there's evidence for that, but again, I can't stress enough, when you consume CNBC, and they have a job to do, right? They got to sell razors and cars, so they got to make it entertaining. I get it. But my challenge is, don't just consume based on that day's price movement. It's about this next 6 to 12 months. And, sorry, I'm going way off. I'm on a soapbox.
You're on a roll.
Forgive me.
He's on a roll.
Did you guys see the
Bureau of Economic Analysis, a U.S. government agency, just revised the last 3 years of GDP. They revised it all down. Do you know what it looks like? The charts we've been looking at. The market was right before the government was right. So that's why we use charts. We use price because it is forecasting. It's the most current information we have. Sorry.
No, I asked the best questions, so that's great. All right, we're gonna do one more. So we talked about all, downtrend this, dollar that this. A lot of people go, well, how's your exchange traded fund doing? You guys launched that thing almost a year ago. What's the latest? What's happening there?
No, I think it's been fun since April. It's outperformed the S&P from April onwards. It didn't in March. March, it hurt things because it was tilted towards financials and banks. It owned 2 regional banks and a financial firm at the time. And that was a once in 10-year event return-wise for that sector. So it impacted the ETF. But since that point, it's doing what we expect it to do as far as owning the stocks with the most momentum. The bucket it's pulling from is the Russell 1000. When we look at the top performers, the top 25 performers in the Russell 1000, it owns or has owned 10 of those, and nothing on the flip side, the worst 25. So what we would like to see, another chart that you could look at, okay, I'll give you chart number 2. EQAL is the Russell 1000 equal weighted. So think about an airplane that has cargo in it, 1,000 boxes, and those are the 1,000 boxes we're trying to select from. If that plane is rising, it makes it easier for the ETF. And so we want EQAL, we want equal to hold right here where it is on the chart, and it's in the packet. Hold right here and move higher, and that will mean great things for the ETF. The other great thing about the ETF is orange below blue, same thing. If it's below that 200-day moving average, it is moving to cash and T-bills without us having to sell anything in your account and incur a big tax burden. So we like how it's performed over the last 6 months. We would love to see an uptrend to show its true potential, but are open to a downtrend, which also would show its true potential through risk management.
Mm-hmm. All right. I'm going to turn over to you for final thoughts. Those are the questions we're going to do for now. I know they have to kind of leave later. We'll see some of you around the office. So I'm going to turn over to Dave for final thoughts.
This tree is in Washington, by the way. It's on a beach. It's been there for hundreds of years. It's adapted to its position. It looks like it. Not all times have been comfortable, but there are times that it's been comfortable. And we know that markets can be the same way. When we look at, for example, the Russell 1000, this is that chart I was talking about. There's an EQAL, the Russell 1000 as well. We want this level to hold. If buyers can support that and we move higher, it means good things for the market overall as well as the ETF. We know the environment we're in is that most stocks are not doing all that great. It's those big 7. And clients will recognize they own big cap in their portfolios and they don't own any bonds in their portfolios. Same with the Russell 2000. We want to stay above this 170 to 174 level, very important. If we can stay above that, that's a good thing for the market. If not, we don't want nothing to do with stocks. We continue to see in our environment, bonds down. Dan talked about that. We don't own any bonds other than T-bills and client accounts. Precious metals, pay attention to that one. We may be talking about precious metals in January. We've had some developments over the last week that are worth paying attention to that go back to, believe it or not, 2018, 2011. But precious metals currently in a downtrend, commodities in a downtrend. We don't necessarily need to be involved in them. While seasonality has us open to the idea of further market upside, this statistic has us open to we're not out of the woods. Okay, and the way I would describe this is when you have a bear market, when you have a new bull market, what's the response from stocks? Looking out 1 year. And the different colors are the different indexes. Blue is S&P, gold is equal weight, and red on my chart is the Russell 2000. This is the weakest response we've seen if this is a new bull market 1 year out, which has made it challenging, and it's why we might be suffering from some loss aversion and a little bit of recency bias. Oh, are we about to roll back over? Open to the upside, here's why. Seasonality. This CTA stands for commodity trading accounts, and they take on equity positions, and they are short equities big time. Short equities means they believe market down big time. When you look at this, all of these low points are at market bottoms. So they're potentially positioned on the wrong side of the boat. And think of that as stacked firewood waiting for a match. If this market starts to move against that positioning, they become buyers and they have to buy to cover their positions. It actually causes a bigger move up than we potentially thought originally. So we have an environment where seasonal is positive. A lot of people are short. How many of you guys think the narrative is positive out there? The media is like super positive about this market. I don't think so. The magazine covers don't represent it, but we're going to stick to price. We're not going to use magazines. We're not going to use TV. Same thing that we used in April and in July, right? We highlighted those things in the past. This is the chart. Rip it out of your thing. Keep it in your car. Whatever you got to do. Above the blue line, we're in. Below the blue line, we're out. 4180, we're in. Below 4180, we're out. What we'd like to see is sustained leadership out of semiconductors. So this chart goes back to the dot-com tip of the bull market. This is semiconductors versus the S&P 500. The way to digest this is when it's going up, it means semiconductors are going up faster or appreciating faster than the S&P. When it's going down, it's doing the other. It's worse than the S&P. We're right at those levels right now. If we break above that, semiconductors are a leading industry. When they go, the market tends to go. If we can get above that level, that would be a huge deal. We want to be aware of gold. This one's huge. This one goes back to 2011. We've consolidated for almost 4 years at that level. If we get what Dan's talking about, a weaker dollar, probably going to see that break out to new highs, and we will own it in client accounts in a K1 free fashion and make sure that we take advantage of it. But again, this is the chart. Above blue, we're in. Below blue, we're out. So at this time, we have some exciting news that I will let Paul deliver about a new team member. It's not on your slide deck. This is hot off the press.
It's hot off the press. So yes, there is good news in the world, by the way. So some things there, but we're excited about how we're helping our clients. We're excited about the team that we have, but we also took a look at how are we going to do that in the next couple of years. And so we're going to announce. So Benjamin, why don't you come up here? So Benjamin Trout's going to join us on our leadership team. So Benjamin, interestingly enough, has been around Client First as a client or a resource for a while. Matter of fact, I'll take you back to our history lesson. For those that were around, when Mike Sheehy passed away, right? Justin reached out to me as just a friend, and I said, here's some things to look out for. I said, hey, there's a guy that manages money. That was Dave. While I was saying that, Benjamin was also connecting Dave and Justin. So it's kind of cool that he's been seeing what's been going on. And we know that he's a great core value fit for us, but also a super huge talent when it comes to people, process, and technology. Because you had a slide where like, wow, there's a lot of people there, right? So how are we going to handle that? What processes are we going to put in place to take care of you is really what this is about. So Benjamin, we're super excited that he's with us. Graduate from Wisconsin Lutheran College, bunch of process stuff from Waukee School of Engineering, married with wife Krista, 3 beautiful kids, loves to fish. So if you're a fisherman or fisherwoman, he's your guy. That makes kind of Justin and Chris a little jealous because they're big fish guys too. So yeah, please, a round of applause for Benjamin. And he's already started with us. He's getting right into it. He's kind of drinking from a fire hose right now.
Good afternoon. Glad to be with you this afternoon. A few things that will align with what Paul said. Benjamin Trocht, good to see you this afternoon. Titles of tax and accounting team lead, and also lifecycle business process director. And you're wondering perhaps what does that mean? First, I think I've got the longest title at Client First. Grab this here, wearing a couple of different hats. So try to work that in a little bit. While I've been a client at Client First for years, while I was doing that, I was leading and developing people, working through a number of different process improvement initiatives, and then where possible, applying technology. All of those things mixed together make systems. And the systems are going to be developing are for you, the client. As Paul mentioned, they're bringing me onto the team because of their commitment to you. If you look at our core values, not only do I align with those, but I'll be delivering things to help uphold those to you. So I appreciate getting to be part of the Client First team. And I appreciate getting the chance to be able to serve you. Thank you.
So he'll be around. I'm looking forward to having him on the team. Big ad for us. We're super excited about that. So now we'll wrap up. I don't have any more trivia for you, so don't worry. So please hand in your feedback forms. We'd love to hear how the team did. Also on there is if you need assistance with certain parts of your financial area, let us know. We're happy to do that. And then in November, we've got our Truistic Financial Planning team coming back up here with Cade and Brad and Justin and a few others talking about hunting for bucks. And typically we focus that one on kind of like implications of tax and tax planning, kind of how to finish out the year to make sure you're not stuck with kind of a big bill. Right? That's your biggest expense is tax, right? So making sure we've got that all, tidied up before the end of the year. So that's what we're going to have going on. If there's any other questions, you guys know how to get a hold of us. It's 262-335-1700. That's listed. And with that, we're going to adjourn. Enjoy the fall. Enjoy football playoffs if you're a fan of high school football. And go Marquette basketball. They're rated number 5 preseason. Okay, that sounds good.